I do want to welcome in our next guest, though, for some insights on the markets and some of the market action we've seen recently. Joining us now, Jim Iuorio, the managing director of TJM Institutional Services. Jim, great to have you back with us. I'd love to just get your thoughts with how the market's been performing so far this week.
So today is the most important day. We got the government reopening last night or this morning or whatever the news is, and the stocks don't like it. We have that old expression, buy the rumor, sell the fact, although I don't think the government shutdown was that massive a deal in markets anyway. But I like to have thought that we'd have a little bit of a rally when it reopened, and we didn't. So that to me means, it's kind of like the same as an earnings beat getting treated by selling the stock. So I don't really love it. To keep it in perspective, though, like the 200-day moving average on the NASDAQ is 15% from the high we put in last week. So we are in a longer-term bull market. To think that we have some room to correct on the downside, yes. You mentioned something about AI and bubble talk. I do believe that AI has entered some level of bubble, and my evidence for that is a couple of weeks ago when OpenAI, every time they even mentioned a company, their stock would rally 10%. To me, that suggested some sort of maniacal fervor. So I do think there's some air needs to come out of that, but it doesn't mean it has to come out of it today. So right now, things look fine in the longer term. The short term, I do think we could see some downside still.
All right, Jim, lots to touch on there, but I want to start with that bubble. If you think we're in a bubble, what stage of the bubble are we in?
Oh, that's a great question. I think it's a relatively early stage. Let's say the first third of bubble creation. Remember, bubbles can always last longer than you think, and trying to predict when they're going to end oftentimes is very expensive. So what you do is you stay nimble, you trim and trail, you put stops in, you buy puts. I know a lot of people who are watching this show don't use options, but they are a good way to protect your portfolio. We in the trading world have always said bulls can make money, bears can make money, but pigs get slaughtered. Meaning, if you get too over your skis and get too greedy and let those positions build up, you are exposing yourself to what could be a very, very painful haircut. And to that point, I fully believe that these AI stocks are going to have some level of like a 30% trade down in the next 18 months. You have to ask yourself the question: is if that happened today, how much is that going to sting, and are you ready to buy more of it?
All right, so if we could see a potential 30% correction in the Mag 7 names, what would be the trigger for that? And also, what advice would you have for people to protect themselves from it?
So everyone always tries to blame a trigger. And usually what happens is the positioning gets so crowded that the trigger looks this big. And it's literally like the straw that breaks the camel's back. And everyone will be like, oh, well, the Fed didn't ease when they said they were gonna, because that could be coming up in December. Now those odds have gone to 50-50. But if that's the trigger that pushes us down, that's not really the trigger that pushes us down. And what is positioning. That's why you have to take profit on these things. One thing I do realize and sympathize with is a lot of people don't like to sell out of positions to pay ridiculous amounts of capital gains. Sometimes you have to. Sometimes you have to reduce your positions and not get greedy. And that's what I've been doing, and buying puts to protect that position as well.
And let's focus more broadly on the markets. You said you think we still have some room to run. If we have room to run, are we running through the end of the year? Are we running well into 2026? Because you also said that we might be ripe for a pretty significant correction or pullback. So what's the timeline on this?
You noticed that I was kind of contradictory. I think in the short term, I think there's a little bit of a pullback to the tune of about 5% from where we are now, probably in both indexes. I think it's a time probably to accumulate. We look at unfilteredinvestor.com. We look at from the portfolio construction standpoint with the weekly bars and use the 8 and 21 moving average. Just today brings us just into that moving average, the distance between the two. That means it's probably a time where it finds some support relatively soon. We're probably about 2.5% off the high already, and I think it's going to be a time to buy it, but not until it can show some strength and move back out of that. So I do think, let's put it this way, is that the main bull fundamental thesis was that the Fed was adding liquidity at a time where we weren't really even sure if the labor market was deteriorating the way they think it is, because they always talk about the labor market. Well, now people are starting to get worried about it. Goldman comes out and says 50,000 jobs lost in October. I believe it was Morgan Stanley said something similar. So now people are thinking the Fed might be easing, or actually maybe not be easing based on what he said in the 29th, but the labor market really is as soft as we think it is. So that's kind of the negative case on the short term. Until that gets resolved, I think there could be some rocky waters.
So, Jim, let's talk about the Fed, because we heard from White House officials yesterday, particularly Caroline Leavitt, that we may not get some of this data that we've been waiting for, this inflation data, this employment data. And we know the Fed has signaled that December is not a done deal. They are more focused on the labor market than they are on inflation right now. At least that was the last language. What is your anticipation of their move in December? And how do you feel about their focus right now and all of the language we've gotten from these Fed speakers? Because in the absence of data, we've been very focused on what these Fed speakers are saying, far more than I think we ever have before.
Sure. Here's what drives me nuts is that at the October 29th meeting, Jerome Powell comes out and he says, yeah, December's not a done deal. We're data dependent, which is the same thing he's been saying since he's been the chairman. It would be irresponsible for him to say, yeah, I'm easing today. I'm probably going to ease in December too. That's just not the way he talks. For the market to have taken him at his word, I think is very odd. But he is at a situation where he's flying blind. Of course, what would be the point of getting the October data at some point anyway? We know the collection method has been messed up. So I say they just forget it, because it's ridiculous to trade off something that we know is inaccurate, and it would be completely inaccurate. So the Fed is flying more blind than usual. By the way, I say more than usual because they're usually flying somewhat blind. We've already uncovered some major problems with the way the government collects data for some of these data points. And but the Fed is flying more blind than usual. I expect them to be more on the easing side as a reflection of their trying to navigate in cloudy skies. And I think they will ease in December.
Do you think they will ease in December? By how much?
25 basis points. I think if they go 50 basis points, it'll seem reactionary. It'll seem panicked. And he loves to portray it as everything is fine. We're just moving in slow increments. So I think something real nasty would have to happen for him to go 50 basis points.
All right, so let's talk about some of the data we have gotten. We got consumer sentiment out near all-time lows, despite the fact that we're still hitting all-time highs in the stock market. What do you think is driving that pessimism from consumers while they still seem to be spending and the markets are doing so well?
So they seem to be spending, but I believe this is coming from the top 30 to 40% who are the asset holders. Normally, those two, consumer sentiment and stock market, are highly correlated. Now they've gone away from each other, and people are saying, oh, look, consumer sentiment is down despite the fact that the stocks are high. I actually think it's another even step further. I think consumer sentiment is down because stock market keeps going through the roof, and people are getting more and more disappointed by the fact that the asset holders are making money, and all the lower 60% have is higher grocery bills. So I think that's affecting sentiment very badly. And it also reflects on Jerome Powell, because he's looking at two bifurcated economies. Top 30% still has a ton of money because assets have been going through the roof. The bottom 60 has very little money. All they have is a recession and higher grocery prices. So I think he's trying to address them, and that could eventually boost asset prices. But I still think the trade's crowded, to put it in perspective.
All right, so a K-shaped economy and a crowded trade.
Oh,
Jim, we appreciate you being with us to talk macro this morning. That's Jim Iuorio.